The difference between mutual funds and ETFs. All right, so we're going to bust out the whiteboard here, and we draw a line down the middle. We got mutual funds over here. We got ETFs over there. All right, so remember, ETFs, we got VTI is a Vanguard Total Stock Market ETF, right? It covers the entirety of the listed stocks in the U.S., what's called the Wilshire 5000. So it's probably about 4,700 issues in there, and everything that is traded domestically in all the prominent stock exchanges, American Stock Exchange, New York Stock Exchange, NASDAQ, I guess Philadelphia, will be in the VTI, the Total Stock Index. There's also a mutual fund at Vanguard called the Total Stock Index as well. So VTI, VTSAX. They literally own the exact same positions, but because one's an ETF and one's a mutual fund, there's a little bit of difference, which we'll talk about here in just a second, or right now. All right, so I actually own this right here, just as a side note, so don't buy it because I own it. Now, the best thing about an ETF is that it trades throughout the day. All right, it's just, you can buy it whenever the market is open, you can buy and sell it. That's just a fact. You can't do that with mutual funds. Mutual funds only trade at market close at 4 p.m. Eastern time. So the minute the market opens at 9:30 a.m. Eastern time, you can buy and sell exchange traded funds. It trades just like a stock, which is in some ways pretty cool. Because let's just say the futures are way down because, I don't know, Sniffy Joe is coming back from the crypt. He's like, I'm coming back. He's got his best friend Obama in there. And you're like, oh no, the market's like, please, we thought you were gone. And now the futures are way down. And you can actually go in at 9:31 and you can buy an ETF right at that time when the futures are way down, and now the market is now active because the futures down most likely will lead to a major sell-off to start the day. All right, that's pretty cool. Now, on the other hand, you can't do that with a mutual fund. You can only put a trade in it only trades at the end of the day. So you can sit there and say, man, the futures are way down. I'd like to buy. I'm going to put an order in to buy VTSAX, but it won't happen until market closes at 4 p.m. Eastern time. All right, so the futures, they might be down to beginning with, and then Sniffy Joe says, I don't know what happens, we arrest him or something like that. We say, Sniffy Joe, you and Hunter are going to jail for whatever. And then the market decline that started the day off just jumps back like a freaking rocket ship to the moon. And all of a sudden, your trade goes in at 4 p.m. Eastern time when the market has recouped. So in this case, you're like, oh man, I was able to buy when Sniffy Joe was coming back from the grave. And now I was able to, but only he was able to buy after they arrested Sniffy Joe. You see what I'm saying? That's the difference between ETFs and mutual funds. You can buy throughout the day and sell throughout the day. Here, you can only buy or sell at market close. It could go the opposite for you, all right? We could say we're arresting Sniffy Joe and Obama, and all of a sudden the futures go way up, pre-market orders, and then at 9:30 Eastern time, you're like, hey, I'm buying because of at 9:30 Eastern time. You bought you bought, all right, and you bought when the trade was way high, and then all of a sudden they say, oh, we're not arresting Sniffy Joe after all, and then the market comes back to normal, and you're like, oh man, you bought when the trade was high, and now it comes back to normal, and you're like, oh man. And then in this case, again, because you can't buy at market open, you can only buy at market close. You got it when the market was more reasonable price, if that makes sense. I know that's an extreme example, but that's how it works. You can buy and sell throughout the day. Here you can only buy or sell at 4 p.m. Eastern time. Now, if you look at it, this is still better. Why? Because the market historically has gone up more than it goes down on any given day. I think it's like 52% up or maybe 55% up on a given day, 45% down or 48% down. So you are essentially the bank here. You have more odds in your favor to buy on a market to go up than to buy when the market goes down. It's just your favor. So generally speaking, ETFs are better in that regard. ETFs, because you can buy and sell throughout the day, you can actually trade options on it if you want. You can sell calls, you can buy puts, the whole thing. So it does give you a little bit more control over your ability to buy and sell. You can't do that with mutual funds. You can even do stop loss orders, limit orders and all that on ETFs because it trades like a stock. So you have much more control on your ability to trade with an ETF than you do with a mutual fund, without question. And you know, if that's important to you, then ETF's the way to go, unequivocally. It's not important to me. I just don't care. But the reason I have VTI as opposed to this, generally speaking, ETFs have lower expense ratios. Now, a lot of people in Bogleheads and other places like, I'm paying 4%, only 0.04, and you're paying 0.05. My ETF is better. Dude, we are so rock bottom in fees nowadays in terms of expense ratios. It's silly at this stage. But with that said, I'd rather pay 4 basis points than 10 basis points. Mutual funds, generally speaking, have higher expense ratios than ETFs. And I think it has something to do with the regulatory compliance that goes with mutual funds as opposed to ETFs. Don't quote me on that, but I think I took my Series 7 in 1999, 2000. I think it all has to do with some of the Investment or Company Act of 1940, something like that, with the regulatory compliance on what they didn't even call them mutual funds back then. It's called like trust funds or investment companies. I can't remember. It's been so long. But anyway, I think there's more regulatory hurdles that the mutual funds have to jump over than ETFs, because ETFs trade like individual stocks. So essentially, there's going to be a little bit lower expense ratios. The expense ratio difference between these two is probably, I don't know, I think this is 4 basis points. You know, that's 0.04. All right. So we're talking 0.4 of 1%, or is it 4/100ths of 1%? I can't remember what it is. It's so low. So if you got 100 basis points is 1%. So 10 basis points is 1/10 of 1%. 0.04 basis points is 4/100ths of 1%. Yeah, that's what that is, VTI. And then Fidelity's got some no-fee ETFs, and it's just the whole thing's, it gets ridiculous how low these things are nowadays. So, but even this right here, the Vanguard Total Stock Index mutual fund, I don't know, it's 8 basis points, 10 basis points, something like that. I mean, is it really that big of a deal? Of course not. We're talking so bottom of the barrel now. Now, you'll have some actively managed mutual funds, and there will be some more higher expense ETFs too, don't get me wrong. But actively managed mutual funds, you look at Wellington or Wellesley, for example, the funds I like at Vanguard, I think they're 25 basis points to maybe 35 basis points, whether or not you have the Admiral shares or not. You know, can that add up? Sure. It's 25 basis points is still pretty rock bottom. Historically, mutual funds used to run you about 1.4%. That's how much John Bogle saved you, the investor, on fees. Historically, it used to be 1.4. I think bonds were like 95 basis points. Now it's less than half that. It's crazy how low fees are in mutual funds. But if you want an actively managed mutual fund, it will cost you more than an index fund for sure, because there's a guy who's running the show. I mean, that's just a fact. He's actively managing it. Is it worth it? Yeah, it depends, I think. For some people, sure. For other people, no. I frankly don't care that much. You know, the Vanguard funds are still going to be quite cheap. T. Rowe Price will be cheap. Fidelity Price will be cheap. You know, all these are going to be more expensive than any index fund, ETF, or mutual fund. It doesn't matter. But generally speaking, you know, the days of getting killed on expense ratios are gone, essentially. Fidelity would be more expensive. T. Rowe Price would be more expensive. Vanguard would be the cheapest mutual funds, but they're still more expensive than their ETF counterparts. All right. So we talked. Now, the best thing I like about mutual funds is that you can set up automatic trades. Can't do that with a stock. You can't say, like, for instance, I put $1,000 a month into, or 2 weeks, something like that, into my brokerage account to buy VTI on a regular basis. All right. Now, because if it goes to my Schwab account, let's just say $1,000 every 2 weeks goes to my Schwab account, I actually have to go in there and place a trade, which I can't stand doing because I can't keep I just can't follow. I can't remember if I got it. I just forget. So I like to set up an account where I can just say every 2 weeks, $1,000 a month is going into my Vanguard account, and they're automatically going to use that money to buy my fund, VTSAX. You see what I'm saying? I just plug it in. So if you're going to do dollar cost averaging, where you're putting money in on a regular basis, this is the way to go, because it automatically does your trade. They get the money to make the trade because it trades at the end of the market day. Now, sometimes like, man, I sent the money to you 3 days ago and it only traded today. Should have traded yesterday or something like that. I get it, but that's the benefit of having the simplicity. I'm just dollar cost averaging. I'm sending money in, sending money in, sending money in. That is hugely important to me. Now, I have my VTI being automatically traded at M1 Finance, but they don't trade it when they get the money. I don't know how they do it. They hold it and then they trade it like once every week or something like that. So, you know, there's some days I'm just sitting on cash. I don't look at my portfolio, but I don't hardly ever look at it because I don't want to go in and see it. I don't want to. I know what I do is I start getting ideas in my head that says I should do this, I should do that. I don't want to do all that. So it's completely autopilot. I throw it in there and let M1 Finance, hell man, they can do whatever the hell they want with it, and then they'll make a trade. Do they make the most opportune time trade? No. At the end of the day, they were talking small potatoes, because every single trade over the course of 20, 30, 40 years of investments isn't really going to make or break it. It's just not. The question is, are you going to get the money in the market versus not be in the market? I want the money in the market. I also don't want to be required to actually go in there and manually make a trade. So I had a little bit of extra money. I dumped $10,000 in Schwab the other day. I had to go in there and manually buy VTI. I had to click the trade button. Easy to do. I don't want to do that on a regular basis. If it's a one-off where I throw $10,000 in, I'm going to go to my Schwab account, hit trade, and do it. But guess what? I still took 2 days before I said, oh man, I can put that money in. I had forgotten about it because it takes a day or two to clear. I can't remember what it was. But it wasn't ready for, was it ready for trade? I can't remember. Maybe it was ready for trade. I just said, I forgot. So anyway, it took me 2 days. I said, oh, I got to go in there and make a trade. All right. I don't want to do that. I've had a case a couple times in my career where I've had money sitting on the side for freaking months on end. I had forgotten about it. And I'm not talking hundreds of millions of thousands of dollars. It's your old buddy Josh. I'm not that guy. But you know, every 10, 5, 2,000 bucks that's sitting there is 10, 5, 2,000 bucks that's not working for me. And I don't like that. So I like to have a mutual fund where I just put my money in on a regular basis and they take care of the rest. The bulk of you guys, that's what you do in your 401k. You're putting the money in, it goes in automatically. You say, this is how I want to invest, boom, boom, boom. Done. You don't have to do anything. You don't have to pull the trigger on a trade. You don't have to do anything. It's just you're putting the money in, the money's invested automatically when they receive it. That's the biggest benefit of mutual funds, is that you just have an automatic trading scenario. In ETFs, you actually have to make a purchase. You have to go in there and execute a trade. And it's, I don't think it's worth it. But for me, I just like the lower expense ratios on ETFs, and I like VTI. That means, again, you should probably shy away from it. But that's how I invest. So I have both. I have VTI in my brokerage account at Schwab. I have VTI in my M1 account. My Schwab brokerage account, I have to actually manually make a trade. In my M1, it does it automatically. Yeah, I hope this helps. Love to hear your thoughts. If I'm missing something, put in the notes and hit that like button. God bless. We'll see you.